You spent years scaling a digital enterprise. You built a SaaS platform, a multi-channel DTC brand, or an Amazon FBA portfolio, generating anywhere from $500,000 to $50 million in revenue. Now, you are preparing to sell it. This is not a standard business transaction. For most founders, transferring this enterprise is the single largest liquidity event of their life. This chart shows the primary threat to that payout: the discrepancy between your initial paper valuation and the actual cash at close. This drop-off happens during due diligence, as buyers use operational risks to slash your valuation or walk away entirely. Exiting a business is a high-risk gauntlet. A single unmitigated risk in your data room can wipe out millions in life-changing enterprise value. When you reach the point of sale, you face an immediate decision. You can navigate a self-serve VolumeX marketplace, or you can hire a specialized boutique M&A advisor. The primary objection founders have to boutique firms like Website Properties is the cost. Hiring them means surrendering a substantial percentage of your final payout. You must decide if giving up that commission actually yields a higher net cash payout, or if you are simply paying for an expensive Rolodex. We need to dissect Website Properties' specific model to find out. We will weigh their 5-stage process, their senior-led constraints, and their fee structure against the net outcomes for the founder. The math comes down to whether trading a slice of your life's work functions as a reliable insurance policy for securing maximum market value at close. The standard volume broker model relies on speed. They list hundreds of sites quickly and hand the daily friction of your account over to junior associates. Website Properties operates on a strict opposing rule: 0 handoffs to junior reps. The senior advisor who opens your deal is the one who closes it. Because these senior advisors built and sold their own digital businesses, they bring decades of specific pattern recognition to the table. They know exactly how seasoned buyers negotiate and how to counter them. Cautionary: this structure creates a hard bottleneck. Because the firm's capacity is severely limited by their senior bench, they will actively decline businesses that lack the complexity or scale to survive institutional scrutiny. The senior-led model trades the easy acceptance of a volume broker for specialized operator-level defense during aggressive buyer negotiations. An unprepared exit operates on a chaotic timeline. Sellers scramble to pull data and answer buyer requests on the fly, leaving them vulnerable to valuation cuts. This flowchart illustrates Website Properties' methodology. It is a rigid, 5-stage sequenced process engineered to replace that chaos with predictability. The input required during the preparation phase is grueling. It demands 2 to 4 weeks of intense data room building and financial scrubbing before a single buyer is contacted. The goal is to identify and resolve red flags internally, long before a buyer's legal team can find them during formal due diligence. This front-loaded rigor slows down your timeline to go to market, and it demands exhausting data gathering from a founder who is already running a company full-time. Enduring that intense internal friction up front is the only mathematical way to survive institutional due diligence intact. If your business relies entirely on your daily involvement, or if your unit economics have clear gaps, going to market right now guarantees a lower valuation. For founders in that position, Website Properties offers an exit enhancement program. This means committing to a 12 to 24-month delay to structurally engineer transferability. This graph charts valuation potential. Selling as is locks you into the lower line. By optimizing operations over 2 years, the program targets the upper curve, aiming to command a 15 to 40% higher multiple at listing. Pausing the sale comes with a stark trade-off. It requires sustained operational discipline, and it leaves your final payout exposed to unpredictable macroeconomic shifts for another 2 years. Delaying your exit is an active, high-stakes investment strategy. You have to weigh immediate cash in hand against the probability of an amplified future reward. Direct. We have to look at how Website Properties gets paid. They operate on a strict success-based fee structure. They charge 0 upfront retainers and absorb all marketing costs, taking a percentage only from the final cash wired at closing. This stacked column chart demonstrates how that structure forces total alignment. To break even on the hundreds of hours a senior advisor invests, the firm has to negotiate a demonstrably higher multiple for your business. Because their revenue depends entirely on closing the deal, they ruthlessly vet buyers and mitigate risks, resulting in an 85 to 90% deal close rate. A success fee is a structural guarantee that your advisor is exactly who should hire this firm and who should handle their exit alone. This matrix plots business complexity on the vertical axis against total enterprise valuation on the horizontal axis. If you run a simple content site under $500,000, or if you strictly refuse to share any equity, you belong in the bottom left. You should use a volume broker or a self-serve marketplace. The top right is the ideal profile for website properties. These are founders of $2 million to $50 million SaaS, multi-channel DTC, or marketplace businesses whose complex unit economics require specialized translation. These founders also require strict confidentiality, which is managed by restricting access to an NDA-gated network of 50,000 pre-vetted institutional buyers. Without a senior advisor acting as a buffer, founders of these complex assets are highly vulnerable to sophisticated private equity legal teams seeking to discount the purchase price. If your business's enterprise value is high enough that a mere 10% swing in valuation equals years of your personal salary, the ROI of a senior advisor protecting that margin mathematically eclipses the cost of their commission.